And joining us to do that right now is Kate Moore. She's the chief.
She works at one of those firms.
At Citi Wealth. Kate, what did you think? Did you get a long night of sleep last night? Wake up well rested?
Yeah, Becky, I feel refreshed and ready for the rest of this trading week. No, I mean, I think like everyone else, we were sorting through and slicing and dicing all of this data and trying to really figure out what this meant for a lot of companies, not just in the U.S., but around the rest of the world. And I woke up this morning with not a huge amount of clarity. I didn't say I know exactly how this is going to hit profits. I know exactly the impact on demand. And I think we're going to see that uncertainty really play out, frankly, over today's trading session.
I would say probably today's trading session and well beyond. I think there are a lot of questions about if this is a negotiation starting point, if we are going to see that. We don't know how other countries will react, but the president has been pretty clear that this is a ceiling unless you try to fight back against what we're doing, in which case he reserves the right to raise tariffs even more. So I'm not sure we know what we're in for.
Yeah, it was a much higher opening bid than I think a lot of people expected.
Yeah.
Consensus on the street and all these buy-side surveys were looking for kind of anywhere between, say, 12 to 15%. These numbers, even if they're the starting point of negotiations, are so much greater than anyone had started to factor into price or into their models that I think it's going to be disruptive.
So what do you tell people to do this morning, whether to buy when you're looking at pretty significant dips? The S&P right now indicated off by about 3 1/3%.
Yeah, we've had this message for the last number of weeks since I joined Citi as CIO, that effectively we don't want to be adding to risk right now. If you have a portfolio that is fully invested, we're going to sit tight and think about being a medium and long-term investor. But if you have cash that you were looking to deploy, the uncertainty factor, whether it's in bonds or in equities, was too great for us to have a really convicted call. And, for our clients, like money is made while you're sitting here and money is made while you're being patient, not when you're trading all of the time.
But is this enough to lure you back in? Do you think, okay, we're back in correction territory, we're down by 10%, or is it just, even though you're seeing these drops, I don't know that I'd venture in at this point until I understand it.
Yeah, look, the price levels are really interesting, and we'll be watching some of the technicals. We want to be thoughtful about when we re-enter the market or we think about adding to risk. But I would also note the uncertainty factor is just starting. I mean, one of the things I kept telling the team going into yesterday is April 2nd is not going to be a clearing event for the market. We have big economic data coming out tomorrow with payrolls. Earnings are just going to be starting. I'm watching really closely how companies talk about what they expect for the balance of 2025, even ex the tariffs, because we know that there was some slowdown in momentum. And we obviously have this big tax bill that's going to need to get done, which will have implications as well. So, even if we felt like we could bake in everything that was announced yesterday, I'm not sure the uncertainty and the inconfidence are in a place where I'd want to add to risk.
The uncertainty is also where the Trump put is, and I can tell you that it may be a lower strike price than what we're used to. Number one, he's hopefully not running for re-election. I mean, I think he's just trolling, but hopefully that's not what he's saying. And even though the 20% gains each year of the last few years, he wasn't president, but I still think he might have the idea that it's not house money, but the wealthy have done really well. The S&P was 2,200 a couple of years ago.
Yeah.
It's 6,000 right now. So at 5,600, I'm not sure him or his advisors at this point are saying the pain is so significant we need to say uncle. So that makes me at least concerned that the strike price on the Trump put could be well below what we're thinking it is. It could be 44,000? Could it be 4,000? What's that? Another, that would be bear market territory.
It's not just the amount of pain that the Trump administration is willing to take. It's also House Republicans, Senate Republicans, how much they're willing to take, because right now they are allowing him to do this with tariffs.
And it's Scott Bessent.
They're the ones who are supposed to have the absolute ability to raise taxes and put on tariffs.
And for how long? We'll obviously have a midterm election. At some point, it feels like an eternity from now, but that will be a consideration, certainly, for all members of Congress. But I think this idea of the put, we've gotten very comfortable with this idea that whether there's a policy put or
it might not work anyway,
or a fiscal put, or a monetary policy put.
Right. And you might not have control of having a bounce. It may have already past the point of no return to where the damage is done. So
the other thing is the EU today, Ursula von der Leyen, I believe, was making some comments just suggesting that, hey, we do export a lot of goods, but that they import a lot of U.S. services. And I wonder if you think about the implications, the implied threat there, the implicit threat, what that would mean for things like financial services and other services that are imported or exported around the globe.
Yeah, I mean, I think some of that's getting reflected in the price action we were talking about and Andrew mentioned at the beginning of this segment. I do want to say, like, it's prudent for all of these global leaders to maybe say they're evaluating the information that came out yesterday without being really reactive. We want to see the leaders be responsive and thoughtful about how they're going to approach.
Well, now you sound like Scott Bessent, who would like to see the other leaders not do anything just yet.
Well, yeah, I want everyone to come with a clear head because there was a lot of emotion, I think, and emotion getting priced into the market last night.
Well, so to me, there's two questions. One is just the uncertainty and how long the uncertainty lasts.
Yeah.
Meaning, like, if this is a long-term negotiation, that's a problem. If it's a short-term negotiation that you don't like, that might be a problem, but maybe less of a problem than something that goes on for a year or two. The other question is, irrespective of whether you think tariffs go into effect or what number they are at, I actually wonder, and this is what I think is happening with the banks this morning, and I think it's going to happen to all the services companies, which are a lot easier to drop, frankly, than actually everything else, which is to say, if you are a business in France or Germany, or name your country, and you have a choice of using, dare I say, the great Citigroup or BNP Paribas or HSBC or some local bank, I kind of think you're going to say to yourself, you know what? Those guys may be good. I may like them. I may have done business with them, but I don't really like what's going on anymore. And it's a lot easier when they're doing their next deal or their next whatever to just not pick up the phone and call you as opposed to actually have to drop you, which is what they have to do in the manufacturing world.
Yeah, I think this is a good question about incremental attention and flows to U.S. companies. And this happens for international asset allocators. You think about big pension funds, sovereign wealth funds, who've all been super overweight U.S. assets. They have this opportunity now to say, for additional money that I need to put to work, do I want to invest in the U.S. or do I want to invest in another country or my own home country? Do I want to rethink that plan?